Critical Man Pictures presents the Forex video training series, Black Belt 4th degree, Scaling. What is scaling? Now that you know how to properly set up proper stops and calculate the correct position size, here's a lesson on how you can get a little creative in your trading. For those trading multiple position sizes, you can get really flexible and creative on how to manage your risk by scaling in and out of your positions. What is scaling and why would you use it? Scaling in doesn't mean weighing yourself before, during, and after your trade, although it doesn't hurt to monitor that too. Scaling basically means adding or removing units from your original open position. This technique can be incorporated into your original trade plan, or for the more experienced trader, if the conditions of your trade changes that you can add or remove from your position in the middle of your trade. Scaling can help you adjust your overall risk, lock in profits, or maximize your profit potential. Of course, when you add to or remove from your position, there are always potential downsides to be aware of. In the following lesson, we'll teach you how all the correct benefits and drawbacks of scaling in and out of trades. We'll teach you the correct way to do this so you don't go crazy because you took out too much risk and blew your damn account. The benefits. Probably the biggest benefit is the psychological one. Scaling in and out of your trades takes away the need to be absolutely perfect in your entry or exit. Let's face it, no one can consistently predict price action or the exact turning point of a market. It's way too difficult to keep expecting the best entry possible at all times. You're setting yourself up for a lot of heartache. The best thing we can do is identify an area of potential support and resistance, reversal, momentum change, breakout, etc. You can enter your position in bits and pieces around those areas and take your trade off at different levels to lock in profits. How much easier would it be on you psychologically if you didn't have to accurately pinpoint exactly where to get into or out of the market? A lot easier, right? Plus, you don't have to be accurate like a sniper to catch a move from its inflection point. Big word, to grab some pips. It also takes a lot of weight off your shoulders anytime you can reduce risk, right? How about locking in profits? Properly executed with a trailing stop, scaling out of winning positions help you protect your profits just in case price suddenly reverses. Finally, if you add more to your open position and the market continues to go your way, your bigger position size will increase the amount that you make for every pip. Drawbacks. The major drawback of scaling when you add more to your position, can anyone guess what the drawback is? You got it. You increase your overall risk. Remember, traders are risk managers first, and if done correctly, scaling in can wipe out your account if not done correctly. Luckily for you, we'll explain how to safely add to an open position. The second drawback is when you remove portions of your open positions, you reduce maximum potential profit. Who wants that? Well, in markets as fast and dynamic as a foreign exchange market, it may benefit you to reduce your risk and take some off the table. In the next sessions, we'll go through some basic examples on the way to scale in or out of a trade. Scaling out. As mentioned earlier, scaling out has obvious benefit of reducing your risk as you are taking away exposure to the market, whether you are in a winning or losing position. When in trailing stops, there's also a benefit of locking in profits and creating a nearly risk-free trade. We'll go through the example trade to show you how this can be done. Let's say you have a $10,000 account and you shorted 10,000 units of euro-dollar at 1.3000. You place your stop loss at 131 and your profit target is 300 pips below your entry at 127. With 10,000 units of euro-dollar, pip value positioned is 1 and stop of 100 pips, your total risk is $100 or 1% of your account. A few days later, the euro-dollar has moved lower to 129 or 100 pips in your favor. This means you have a total profit of $100 or 1% gain. All of a sudden, the Fed releases dovish comments that may weaken the euro in the short term. You think to yourself, this may bring dollar sellers back to the market, and I don't know if the euro-dollar will keep going down. I should lock in some profits. You decide to close half your position by buying 5,000 units of euro-dollar at the current exchange rate of 129. This locks in the $50 of profit into your account At 5,000 units of Eurodollar, 1 pip is valued at 50 cents. You closed profit of 100 pips. 100 pips times 50 cents is $50. This leaves you with an open position of 5,000 units short Eurodollar at 1.3000. From here, you can adjust your stop to break even, 1.300, and create a risk-free trade. If the pair moves back higher and triggers your adjusted stop at 1.300, then you close out the remaining positions with no loss. If it moves lower, you can just ride the trade to more profit. Obviously, the trade-off for taking some off the table is that your original max profit is now reduced. Now, if the Eurodollar ends up falling to 1.2700, and you had caught the 300 pip move with a 10K position, your profit would have been $300. Instead, you closed 5K units at a 100 pip gain for $50, and then closed your remaining 5K at a 300 pip gain for $150. 50 cents per pip times 300 pips, $150. Together, this makes $200 gain versus your original $300 max profit. The decision to take some profit off the table is always up to you. You just have to weigh the pros and cons. In this example, the trade-off is better profit versus peace of mind, smaller locked-in profit, and creating a risk-free trade. So, what's better for you? 50% more profit, or being able to better sleep at night? Remember the possibility of the market moving beyond your profit target and adding more bling-bling to your account. There's always much to consider when adjusting trades, and with practice over many trades, you'll find a process of taking off trades to feel more comfortable to you. Next up, we'll teach you how to properly scale into positions. You may be asking, why would I want to scale into a trade? Scaling into positions, if done correctly, will give you benefit of increasing your max profit. But as they say, higher reward means higher risk. If done incorrectly, the value of your account could drop faster than you could even think about clicking the close button of your trade. Before you know it, you'll be staring at your computer screen, eyes wide open, and watching your account get margin called. Now, we don't want that to happen, right? So fucking pay attention. What separates the correct way from the incorrect way is the profitability of your open position where you add, how much you add, and how you adjust your stops. In the next 2 sections, we'll teach 2 potential scenarios for scaling into a position. Since traders are risk managers first, we'll also touch upon the no-nos of adding to an open position. Scaling into a losing position. The first scenario involves adding to your position when the trade is going against you. Adding more units to a losing position is tricky, and in our view, it pretty much should never ever be done by a new trader. If your trade is clearly a loser, then why add to it and lose more? Doesn't make any sense, right? Now we say pretty much, because if you can't add to a losing position, the combination of risk of your original position and the risk of your new position stays within your risk comfort level, then it's okay to do so. To make this happen, a certain set of rules has to be followed to make this trade adjustment safe. Here are some rules. The stop loss is necessary and must be followed. The levels of position entry must be pre-planned before the trade was put on. Position sizes must be pre-calculated, and the total risk of the combined position is still within your risk comfort level. Let's take a look at this simple trade to see how to do this. Where will you enter? From the chart, we can see the pair moved lower at 1.32, and then the market saw a bit of consolidation between 1.29 and 1.30 before breaking lower. After bottoming out around 127 to 128, the pair retraced to the area of recent consolidation. Now, let's say you think the pair will return to the downside but are not confident picking an exact return point. There are a few scenarios on how you could enter the trade. Short of the broken support trend resistance level of 129, the bottom of the consolidation level. The downside of entering at 129 is that the pair may move higher, and you could have potentially gotten in at a better price. Wait until the pair reaches the top of the consolidation level, 1.30, which also happens to be a psychologically significant level, potentially great resistance level. But if you do wait to see the market reaches 1.30, then you run the risk of not making the market move all the way up and drops down lower, and you'd miss the return to the downtrend. You could wait until the pair tests the potential resistance area, then moves back below 1.29 in the downtrend before entering. This is probably the most conservative play. You get a confirmation that sellers are back in control, but then again, you miss in on getting the downtrend at a better price. What to do? Why not enter at both 129 and 1.30? That's doable, right? Sure it is, as long as you write down all this before the trade and follow the plan. Let's determine our stop level. For simplicity, let's say you pick 1.31 as a level that signals you are wrong, and the market will continue higher. This is where you will exit the trade. Second, let's determine our entry levels. There is support resistance at both 129 and 130, so you'll add positions there. Third, we will calculate the correct position size to stay within the comfortable risk levels. Let's say you have a $5,000 account and you only want to risk 2%. This means you are comfortable risking $100, $5,000 account times 0.02 on this trade. Here's one way to set this up. Short 2,500 units at euro-dollar at 1.29. According to a pip calculator, 2,500 units means your value per pip movement is 25 cents. With your stop at 131, you have a 200 pip stop on this position, and if your stop hits, that's a $50 loss. Value per pip movement times 25 cents times stop loss, 200 pips. Short 5,000 units at the euro-dollar at the 1.30 level. Again, according to our movement calculator, 5,000 units of euro-dollar means your value per pip is 50 cents. With your stop at 131, you have a 100 pip stop on this position. If it hits that stop, 50 loss is the value per pip movement at 50 cents times stop loss at 200 pips. Combined, this is a $100 loss if you're stopped out. Pretty easy, right? We have created a trade where we can enter at 129, and even if the market went higher and created a losing position, we can enter another position and stay safely within our normal risk parameters. And just in case you were wondering, the combination of the two trades creates a short position of 7,500 units at euro-dollar with an average price of 129.66 and stop loss spread of 134 pips. If the market went down after both positions were triggered, then a 1-to-1 risk to reward, $100, would be achieved if the market hit 128.32, 1.2966 average entry level, minus 134 pips your stop. Because the bulk of your position was entered at the better price of 1.30, euro-dollar doesn't have to fall very far from the resistance level to make a great profit. Nice. Adding to a winning position. Now the fun stuff. If you catch a great trending move, scaling into it is a great trade adjustment to increase your maximum profit. Again, just like Peter Parker, with great reward there is great risk. So the rule is to follow safely to open a position. Let's go over those rules. Predetermined levels for adding additional units. Calculate your risk with the additional units added. Trail stop loss to keep growing position within comfortable risk parameters. To explain this strategy a little better, let's go through some simple trade examples, shall we? We have Tom, the trend trader, closely watching the euro-dollar, and after a bit of consolidation, he thinks traders will push the pair higher, which leads him to plan on buying some euros against the US dollar at 1.27. First, he sees that recent consolidation never really traded below 126.50, so he decides his stop will be below that level at 126. Tom also thinks because it's a psychologically significant resistance level, 130 would be a great level to take profits because the rally may stall there. Tom buys 10,000 units of euro-dollar of 127 and sets a stop at 126. With a 100 pip stop and 300 pip profit target, his risk to reward ratio is 1-to-3. That's pretty fucking awesome. He usually only risks 2% of his account per trade, but this time he's really confident with his trades, and with the great risk-to-reward ratio, he decides he will add more if the market moves in his favor. He decides that he'll add more every 100 pips and trail his stop by 100 pips. Because he planned on adding more units, he decides to start off with an initial risk of 1%. With an account balance of $10,000, Tom's initial risk will be $100, $10,000 times 0.01. With a 100 pip stop and $100 risk, he has determined his initial position size to be 10,000 units. He will add 10,000 units every 100 pips and trail his stop every 100 pips. let's take a step-by-step look at the change in risk-to-reward ratio with each addition. Tom buys 10,000 units of Eurodollar at 127 and sets his stop to 126. Tom buys 10,000 units of Eurodollar at 128 and moves stop to 127. Tom adds 10,000 more units of Eurodollar at 129 and adjusts the stop again to 128. This simplified example shows the basic techniques of how you safely add to winning positions and how effective it can be to maximizing your profits. Now, before you go pressing up every winning position you have, you better be aware that adding to winning positions may not be the best tool for every market environment or situation. In general, scaling into winning positions is best suited for trending markets or strong intraday moves. Because you are adding to a position as it goes your way, your average opening price moves in that direction as well. What this means is if the market pulls back against you that you added, it doesn't have to move far to get your trade into negative territory. Also, you should know that scaling into winning positions in range-bound markets or periods of low liquidity leaves your trade open to being stopped out often. Lastly, by adding to your position, you're also using up any available margin. This eats into margin that could be used for other trades. You have been warned. The summary. There we have it. The coolest guide ever on scaling in and out of your trades. Let's see how much information you've soaked into your fucking noggin. Here's a quick review. Always use stops. Only add to losing position if the risk of your combined positions is within your risk comfort level. If you add to winning positions, always trail your stop to control the added risk of a bigger position size brings. Calculate the correct position sizes and where you will add to, remove from your position before entering the trade. Scaling into winning trades is best applied to trending markets. Scaling out works well in range-bound markets. So now you know the correct way of scaling in and out of trades. Always follow the rules, and sooner or later, you'll catch the one move that'll make you some serious money.